how capital is managed when markets never close. Digital asset markets never pause. There is no opening bell, no closing auction, and no overnight halt that naturally limits exposure. When markets operate continuously, capital is continuously exposed. This reality changes how risk must be understood and managed. Why always-on markets change capital risk? Most traditional risk frameworks were built for markets with defined trading hours. Digital asset markets ignore time zones, weekends, and holidays. Volatility often emerges during periods of thin liquidity, reduced participation, or limited oversight. In this environment, capital exposure depends less on market timing and more on operational readiness. Poor escalation paths, unclear authority, or inconsistent monitoring can amplify losses even during modest market moves. Access is not the same as control. Always-on access creates a false sense of safety. The ability to trade at any hour does not guarantee effective risk management at all hours. In fact, unrestricted access without structure often increases downside exposure. Capital preservation begins with accepting that constant availability introduces constant responsibility. Why speed does not protect capital? Speed without discipline often magnifies risk. During stress, rushed decisions can worsen slippage, increase operational errors, and introduce unnecessary exposure changes. Capital protection depends on predefined behavior, not reactive action. Restraint is not weakness, it is a risk control. Staffing discipline in 24/7 markets. Managing capital in continuous markets requires monitoring, not constant intervention. Effective staffing models prioritize consistency of judgment, clear escalation authority, defined conditions for exposure changes. Without discipline, round-the-clock coverage becomes performative rather than protective. Fatigue and emotional responses increase volatility instead of controlling it. Capital risk management values consistency over activity. Escalation frameworks matter most. When markets move suddenly, response speed is often constrained by governance, not technology. Disciplined frameworks define escalation thresholds in advance. Decisions are triggered by exposure, liquidity conditions, and system stress, not improvisation. This approach prioritizes capital preservation over opportunity capture, exposure reduction over tactical positioning, process over discretion. Not every move requires action. Often restraint protects capital best. Liquidity controls in continuous markets. Liquidity in digital asset markets fluctuates sharply by time and conditions. Thin liquidity often coincides with overnight hours, holidays, and stress events. In these moments, exposure changes can have outsized impact. Disciplined capital management relies on predefined liquidity thresholds. The goal is survivability, not optimization. Managing exposure without constant adjustment. Always-on markets create pressure to act frequently. Frequent repositioning increases transaction costs, execution risk, and behavioral bias. Effective capital management emphasizes intentional exposure sizing and tolerance for volatility. Consistency in exposure behavior becomes a form of risk control. Kenson Investments provides educational research and disciplined market awareness to help institutions understand how capital is managed in 24/7 digital asset markets. If your organization is navigating continuous exposure, clarity starts with disciplined design. Visit kensoninvestments.com and connect with our team.